Good afternoon, everybody, and welcome to this presentation with Movinn in connection with the company's report for the first quarter of 2022. The company is today represented by CEO Patrick Blok. And my name is Alf Riple. I work at Västra Hamnen Corporate Finance, and I will be your moderator for today. We will start with a short presentation by the company, and after that we will have a Q&A session. Everybody who's listening can ask questions. There is a control either on the right side of your screen or the bottom of your screen, depending on what device you're using. You can expand that and write your question there, and I will post the questions to Patrick, and Patrick will try to answer. So all that remains for me to say is that this session is being recorded. The recording will later on be found on Movinn's homepage and on Västra Hamnen Corporate Finance channel on YouTube. So with that, I give the word to you, Patrick.
Thank you, Alf. Thank you for that. Thank you for hosting this conference for us. Happy to attend. Yes, as you correctly state, we recently launched or published our Q1 report covering the financial results for the first quarter of this year, and I will run you through it, and hopefully there'll be a lot of good questions. I'll be happy to answer whatever question that might be. The subheader I've called 51% revenue growth and general performance in line with expectations, and we maintain our guidance for the full year that is unchanged and the same as it was in the annual report that we published a month ago or so. To those of you who don't know me, I'm the CEO. I've been the CEO of Movinn since 2017. Before that, I was part of the team that launched Movinn. We founded the company in 2014. I've been working in the industry before joining Movinn. I've been doing some real estate development, and I've been working in the service apartment sector in Denmark and in the UK. And my background is as a political scientist. I have some decent statistical skills and decent analytical skills. This is the highlights from our CEO messages. I'll run through them. We are maintaining a substantial top line growth. As mentioned, we have realized a top line growth of 51%, and general performance is in line with expectations as well. Q1 is historically a weaker quarter. We've been disclosing this earlier as well, both in the Q3 report and in the annual report. We have this seasonality pattern where we have previously ranged the quarters. Q2 is the strongest quarter historically, followed by Q3. Then Q1 is the third best quarter, and Q4 is the worst performing quarter historically. That's due to the general seasonality of our major client segments, how that is evolving. So Q1 is weaker than average, I would definitely say. So that has something to say about the bottom line metrics, and also we are maintaining a pretty steep growth rate, which is also tearing a bit on our margins as we expected to, and as we've earlier also kind of communicated. We have realized an EBITDA margin of 11.5 and an EBIT margin of 3.3. We have increased our unit number nominally by 17, corresponding to a growth of 5.7% for the quarter. We're also working with our pipeline. Some of you who have been attending these earlier know that we disclose the pipeline and we transparently show how the pipeline is evolving. The pipeline is the inflow of new apartments and how they come into the portfolio and when they come into the portfolio, because adding new apartments is an important growth driver in our business. We have secured if you both take the realized growth in Q1 and the pipeline from Q2, that takes us to approximately 75% of the total pipeline that we kind of promised the market before or guided on the market for the year. We expect to reach the target at year's end, you know, on the back of this growth so far. So that's a positive one. We are launching our first subsidiary in Q2. It's in Malmö, so close to your home, Alf. And we are working actively as well to up the unit number in that region. So I think I was at the Malmö launch. That is scheduled to go ahead in Q2. We are currently putting the apartments into operations, and we've done the early homework of having some good chats with the potential clients, and we think that we are pretty confident that we will have a decent launch in the region. It seems like there's a lot of potential, and that the prospect of having some added supply there is something that the clients are positive about. That's the feedback we get in general. We are very happy about that. To kind of put a bit of focus on the on some of the risk factors. Obviously, there's some macroeconomic stuff happening in Europe right now that we need to pay attention to. We have inflation that is on the rise, energy prices that is on the rise, something that we are monitoring, because we have to obviously manage the long-term effects on this, and the general or direct implication of this is that some of our variable costs can increase as a factor of this, but we're monitoring this. We are able to change our pricing pretty dynamically. So even though there is a bit of stickiness to the short-term cost increases, we're able to kind of offset that as we go. But it is something that we are looking at and want to stay prepared about, especially high inflation rates. That's not something that's healthy for the economy over the long run, I would imagine. So we are managing those risk elements carefully. And the last thing is that we maintain our full year guidance for the year as published in the annual report. I'll come back to that later in detail. Just to do a quick recap on the business model for those who is unfamiliar with it or have forgotten about it. It's we have this asset light business model. Some might also call it a subscription business model. We don't have large balance sheets. We don't own we don't own real estate at all. What we do is we go in and do these partnerships with the real estate, different real estate developers, different real estate investors, with different asset classes going in and doing a kind of win-win partnership there. We then make the property ready for our operations and rent it out to primarily B2B clients. That's the main segment. So the corporate segment is a vast one. We also have the insurance market. So when people are unfortunate and has damages to their homes, we can go in and offset that temporary need for a plug-and-play solution. And then obviously the clients get a lot of benefits and services. That is why we are here, so to say, to offer this convenience and plug-and-play product that you wouldn't get in the normal market. Our current presence is as shown here. We are covering the three largest cities in Denmark. Copenhagen is the primary market. There are also other cities in Denmark that are interesting, and then I've also shown the Malmö-Lund region as well, where we are launching in Q2. So we are progressing as planned, and our intention is to cover as much of the region as we can in markets that is obviously of strategic importance to us. And some of the underlying drivers that we look for when we identify a market is obviously good presence of larger companies. We have some of the large Malmö-Lund companies. They use us already in Denmark, so we are kind of looking at these factors. We also look at different industries that are a part of the entire diversification of the market, so that we don't kind of rely on one industry to be present somewhere. So we look for a good diverse activity of different kind of businesses to begin with, and obviously geographic locations. Is there good infrastructure, ports, and similar. important part of our implementation of our strategy has always been to develop our own tech products, and that's part of this entire prop tech industry that we are seeing. Everybody that's operating within real estate knows about prop tech. It's important to figure out new ways to deliver services more cleverly, to utilize existing space more cleverly. There's a lot of good trend lines there that is interesting within real estate, and we have had this focus from the get-go to develop our own products, and we do this in-house with our own IT department. So we have some different products in place that are working and performing well, and helps us to deliver a good client experience, and also to do so without having a massive need for manpower, which is obviously important both when you're operating and want to scale, but also when you're launching new cities. You don't want to have a major cash burn by first building a huge organization and then having to establish your revenue streams afterwards. So we are pretty light on our feet, so to say, and that's all part to the in-house tech development that we do. Another major investment post is FF&Es, of course, so furniture, fixtures, and equipment to translate. It's a large item on our balance sheet, putting actual stuff into the apartments, because they have to be a plug-and-play solution. So everything has to be there when people arrive. People bring their clothes and their toothbrush. That's what we normally joke about when we explain the concept to new clients. And since 2019, we've been doing furnitures in-house, developing our own furniture brand, designing it, and having it produced in factories, different places in the world, some in Europe and some in Asia. And besides the fact that we actually have limited our ongoing investment a lot, we are also able to kind of refurb pretty efficiently, and also the supplier certainty has been greater than what we kind of buy from third-party suppliers. So the lead times are not as long as we've experienced, because we have these kind of shipping lane bottleneck somewhere. So that's been a positive factor. And the last thing is that commercially it sets us a bit aside from everyone else. Us doing this in-house makes it very iconic and a bit hard to copy, so to say. Our financial highlights is being gathered in this slide. I'm reusing the terminology earlier used, so I'm highlighting the same stuff. One of them is green, that's the revenue growth, that's approved. Another one has turned from green to yellow, that's our cash flow from operations. Our cash conversion ratio is not as strong as it normally is. It is as expected though. The reason for this is that we are bulking up on FF&E. We are upping our warehouse capacities to kind of so that these sorts of things will not be a stopping factor in the growth that we've promised and the growth that we want to deliver. So we're upping on different items, so to say, to be ready for the growth that will come in the next couple of quarters. Our EBITDA margin is from operations is 11.5%. I've highlighted this in yellow. The reason for this is that these highlights is part of the long-term guidance, our value driver guidance, and it's also part of the when we kind of track the progress. So I'm showing you the highlighted points. The ones in yellow are below the long-term guidance. The ones in green are within the long-term guidance. It's important to remember that Q1 historically is a weaker quarter, so that is kind of why the margins are as they are. The EBITDA margin is approved, I would say. It's so we're happy about it, but we want to bring it up above the 15% mark that we have communicated earlier. The ROIC is 6.3, which might seem a bit low, but also important to remember that this is an annualized figure, so you're annualizing with data from a weak quarter, so that's why it looks a bit subpar. And the cash conversion ratio, I mentioned this earlier, we have some working capital that we are tying up into the kind of future prospects. But all in all, it's approved, and I'm expecting these to also approve in the next quarter to come. Our change in units nominally is 17, translated into a percentage that's 5.7. 5.7. We, as someone might remember, we are guiding on the 20% mark, so we're above that, which is good. Also, keeping in mind that Q1 is a weaker quarter, so normally we wouldn't kind of be in front of the curve already. We would take in more growth in Q2. So that's also within the range that we have communicated earlier. Revenue per unit is also approved, and the vacancy is below 10%, so that's also approved. The pipeline, I'm talking a lot about pipeline, but that's because it's important to understand that a lot of our growth comes from our ability to add, to kind of grow our portfolio of suitable units that we can use for our purpose. And we show the pipeline very transparently a couple of years in advance, so that the market will know what larger project might come in and what has to be renegotiated. Also, if God forbid we at some point comes to larger projects that has to be handed back, we will also show this so that people can see the long-term development in the pipeline very transparently. We're only showing larger projects. We're not showing organic growth. So if we get, so as you can see in Q1, we got 17 apartments. They are coming in organically. They're coming in ongoingly. So that's not something we disclose, but larger projects will be disclosed. And the one in Q2 that we actually just launched a couple of weeks ago is in the bulk of those are in Odense. Another important milestone is that, as we have disclosed earlier, we had 2 larger deals that were set to be renegotiated next year. We have successfully renegotiated both of them, meaning that that we can then remove this from the pipeline going forward. So that's obviously also part of an important part of our risk management, that we can renegotiate units that we like and that we want to keep in the portfolio. And we've done so with the 2 major ones that were set to be renegotiated next year, which is positive for sure. And part of why we are able to do so is it kind of displays some track record as well in doing this, should give the market a bit of ease that we are offering some good value to our partners, meaning that sometimes we will be unsuccessful, maybe, I don't know, but so far we've been successful in renegotiating larger deals. The guidance for 2022, I'm just going to touch on it real quick. It is unchanged as stated. We're expecting to exit the year with 365 units in existing markets, corresponding to between 360 and 365, sorry, corresponding to a growth of 20.8 to 22.4. We are guiding on revenue in the range of 67 to 72 million Danish, corresponding to a top line growth from 2021 between 19 and 28%. We have an EBITDA range from operations between 10 and 12, and 9 to 11 after extraordinary kind of IPO related costs. Our EBIT is guidance is between 5.5 and 7.5 million Danish. We are launching Sweden as mentioned, so that kind of ticks a box there on the new market. We're obviously looking to do that more aggressively, but some of it is a bit out of our control, and we have to be patient. But we feel confident that we will be able to do these market launches fairly as planned. And the last one is the cost of debt. It's a minor one, but it is, if you're very fond of doing financial models, then we expect to take our cost of debt down to 4.06 from existing 4.9. The roadmap, I'm not gonna, this is also something you've seen earlier from earlier reporting as well. I'm not gonna go into major detail on it, but we have these kind of value driver metrics that we are guiding on to give the market a understanding of the long-term potential in our stock and our value creation. And we have this 20% compounded annual growth rate. We have that one apartment is expected to average a revenue between 180,000 and 225,000 Danish a year. We aim to keep vacancy below 10%. We want to do 1 to 2 new cities a year, or new markets a year. We want an EBITDA margin above 15. That's also the kind of long-term aim, and we are on our way to do that already. And then an ROIC of above 18%. So this should give people the long-term guidance needed to kind of pin us down to something, so to say, or to kind of keep us keep track of how we perform. And if you're tracking the progress here, I've shown that we can tick 4 out of 6 boxes from this quarter. The 2 remaining ones is the EBITDA margin and the ROIC. Again, keep in mind that Q1 is a bit weaker than average, so I expect the next quarter to be better. But that's one of the major parts. And again, the growth rate is also tearing a bit on bottom line margins. It cannot be avoided. Doing 51% top line growth will have a tear. That's also something that we need to live with in the short term. And looking at the map on the right side of the screen, we are very well present in Denmark. We're looking at other cities in Denmark as well. We have the Swedish launch imminent, and then we're looking at Germany. Germany is of course an interesting market as well, being the major economy in Europe, etc., etc. So that was it for me. Thank you for your time. Over to you, Alf.
Thanks very much, Patrick. I'll just repeat to everybody who's listening that you can write questions to Patrick that he'll answer it here during the session. There's a control either on the right side of the screen or the bottom of the screen. It might be indicated with a talk bubble or labeled questions. You can enlarge that and write your question there, and I will read them out to Patrick. But just to kick it off, first of all, congratulations on a strong quarter, 16.25 million Danish in Q1, and that's even in a quarter that you yourself label as seasonally pretty weak compared to the other quarters. Now, I was just wondering, I mean, if I take that number and just as a technical assumption, say that you would have 4 equally strong quarters, the same turnover in 4 quarters this year, you would end up with an annual turnover of 65 million Danish. Now that's just without any growth at all. You're almost at your guidance range of 67 to 72 million Danish. So is your guidance really ambitious enough, do you think?
Great question. Again, the politician answer is that we would rather be a bit conservative and then deliver a positive surprise to the market than being overly ambitious and then having to disappoint. As it is right now, the trajectory is strong. However, and we also expect Q2 to be strong, and then we will add the growth. Meaning that we feel confident that we can deliver on the guidance as it is. There's some uncertainties, obviously, that we cannot foresee if we turn the clock 6 months out in time. But the general, I guess that the short answer is that we would rather be on the careful side. This is also our first full year as a listed company, so we are, we don't want to start off by disappointing anyone. If we can see that we keep accelerating and gaining momentum, we will obviously always try to be as accurate as we can on the guidance. But right now we would rather be conservative than be overly kind of we want to over deliver instead of over promising.
I see. And I mean, in terms of risks on the horizon, I mean, lots of companies are now worried that what's going on in Europe with the war in Ukraine, the sanctions against Russia, and the general security threats that a lot of European countries are feeling, that they would in any way affect demand for the products. Have you seen any effects at all on the demand for your services?
No, not yet. Obviously, there can be a bit of stickiness to it as well. The long-term effects, we probably haven't seen that of the war. If we're talking about the war, we have even if the war is stopped tomorrow, there will sanctions imposed on Russia will probably run for a good amount of time. That being said, our demand, could probably have included this slide in this presentation, but if you recall from the Q1 presentation, we always disclose our risk diversification on the clients to show that we are pretty well diversified. So if I can give you an anecdote from earlier on, we've had larger clients that for some reason has taken a drop in demand, but us being so well diversified allows us to kind of offset that by different segments or different clients kind of upping that share. So the short answer is no, we haven't seen any effects on demand as it is yet. The long-term implications of it is yet to be seen, obviously, but so far we haven't experienced any drop or anything like that. We don't have any dealings with Russia, or we don't have any Russian suppliers as well. So we feel pretty safe harbored there for the time being.
Okay. But of course, another implication of the security situation is that it has caused a rise in inflation and rising interest rates, and probably as a prolonging as a continuation of that, you're seeing rents going up. You said that there is most of these price increases or rent increases you can pass on to the customer side, but there's also some stickiness. Could you elaborate a little bit on what this is? Why is it sticky?
Yes, of course. So the long-term rental contracts we have in play with our clients, they have the same kind of inflation clause as we do. So, or in technical terms, it's the net price index, net consumer price index, the changes in that. So that can be passed on. The short term, the deals that are a bit shorter that are set to expire in the next couple of months, there's no option of kind of changing those, but we are on front on I would say, because we change our pricing dynamically to stay on the front. To be totally honest, when we did our kind of budgeting and all that back in November, December last year, we didn't expect that inflation would rise by 4%, obviously. But it is something that we can manage fairly quickly by dynamically monitoring it and dynamically changing our pricing accordingly. Our costs are being once a year. They'll be if you take the rents just as a general rule, once a year they will be changed. That happens in January and February, and then if we are in forefront when monitoring this, we can have our pricing be dynamic as well to offset any increases there. Some of it cannot be done overnight, but most of it can, and that's something that we monitor closely.
Sorry.
Yeah, the energy price hikes is basically the same answer. You have to stay on the forefront of it and change your pricing accordingly. There will be some stickiness to it, but we can kind of by being on the forefront of it, we can change it back. We can then adjust the prices that we pass on to reflect the cost increases that we are experiencing. But that being said, we're not. Hopefully, next year the inflation numbers from April just got out in Denmark. I think it was 6.7%. The rate was. That's obviously something we need to monitor closely, because we don't want too many years of compounded inflation rates in that regard. That'll take some purchasing power out of the economy for sure.
I was thinking also, since you are constantly rotating your tenants, you must have a lot of opportunities to change prices every time you change a tenant, right?
Yeah, we do that. There's obviously a commercial aspect to it. It has to be, but it has to be market conform. But a lot of it we monitor ongoingly and change accordingly ongoingly, so that inflation will not carve out any any long-term kind of profits, so to say. But in the short term, there might be a bit of stickiness, as we have disclosed. But we have the option to dynamically offset it ongoing.
But of course, one thing is that you can pass on cost increases to your customers, but another question is how much cost increases can your customers absorb? So is there any, have you seen that the customer side is starting to question whether or not to bring in overseas personnel at all, since obviously with higher residence costs, it's going to be more costly to them?
Yeah, again, it's not. We haven't experienced anything yet. But again, from a commercial aspect, I wouldn't feel happy getting 6% compounded cost increases in the next couple of years. So that's obviously something we need to monitor. But as it is right now, demand is very strong and stable, and price hikes is just part of the world right now, I guess. So it hasn't been any issue so far. But again, we're not using it as an excuse to just up everything. We are looking at, so our energy prices, for example, they might consist of maybe 1% of our total costs. So if they go up by 10%, we will not then just it's not that it's not so dramatic in the larger picture or in the law of huge numbers, and we would obviously, we don't want just to pass on everything. I've read a lot of news stories about companies that are probably a bit too steep in their price hikes, and we are trying to keep it as much in bay as possible.
I see. You mentioned in the report that you are looking at different ways to get more long-term control of your pipeline, in referring to new markets. What are the options that you're considering to achieve that?
Great question. We are considering. I'm a bit, as historically our growth rate has been as it is, and it looks like it's accelerating a bit. So I'm in all, I'm happy about the progress we're making. But I feel sometimes I can feel a little bit annoyed about the fact that a lot of it is kind of out of our control. So, and especially doing new partnership, we have some great partnerships, existing ones, a lot of trust between the parties, all is well there. But especially doing new partnerships, it's a risk factor that we have to manage in a way. And some of the stuff, one of the ideas that we have been bouncing off each other is, should we do like a huge strategic partnership with a large real estate holder, for example? That could be a mean to achieve that goal. One could imagine it's probably not the right time right now with all this financial unease happening in the market, but one could imagine as well creating some sort of partnership model or whatever that allowed you to, I don't know, just exclusive partnerships with a large real estate holder that could secure you, cross-European growth. That's some of the strategic options that I'm very interested in looking at, and that would allow us to manage this completely. Again, it's working out well, but in the long run, it would be nice to have a bit more control of the pipeline. We've also thinking about going in, maybe doing some asset management of some portfolio of some property portfolios, which would allow us to go in and control the units, and then we can just how we prefer growth. We can then determine the growth rates a bit better. I don't know if it makes sense. It is on a high strategic level, it is something. Should we have someone who could buy real estate for us, and instead of these partnerships we're doing now, which is a bit more, kind of random, so to say. Should you do it more systemically, and on a larger time horizon?
I see. Good. I was going to ask you also about the previous acquisition that you made of Copenhagen Suites. Are those units now completely incorporated in your operations?
Not really. I think we've passed the 70% mark, so it's coming along. But and in general, it's working well. We have two offerings in one, so to say. We would prefer to have everything streamlined, obviously, but it just takes some time. But we've integrated just below 70% of the portfolio so far, so that's good. And the remaining ones are rented out, and everything's is well. Nothing much to report there. But what we wanna do is up the service, up the quality, up a lot of stuff, and that's what we've done with a lot of the existing units, and what we will continue to do so.
All right. Another thing that's on the horizon is the launch of your service, Collective Yo-Yo, the furniture rental service. Are you planning a big launch and big investments in marketing and things like that, or are you going to have a more low-key soft launch?
We're not gonna. Yeah, we are gonna spend the required funds in marketing. We have a right now the launch is conditioned by our ability to build the software, so we're working on that right now. It takes some time to get it right, and that being said, a lot of our existing clients has a massive need. So there's a lot of synergy effects on our existing clients and the service that we offer already. So that's a plus. And then we will go in on a marketing. We're not going to buy TV ads and stuff like that, but we are going to do it pretty targeted. And because we have a very good understanding from our earlier testing who is in need of this, if we are to explore the synergies we have already. And the furniture that we intend to rent out is something we have on stock already as well. So we will be able to manage our working capital a bit better by getting those furniture that we already have in the warehouse out and working instead of sitting there waiting to be deployed. So a lot of effects. So I don't know if I answer your question. I'm not going to do TV. But But the soft launch is not. It will be okay. It will be an organic kind of growth rate. But we will build a super nice piece of software and a nice website, creating this universe of options that we can offer our existing clients, keeping it more one-stop shop, keeping the lifespan of the client longer. It's very normal that people come. If we look at our corporate segment or in the insurance segment, for example, if they need if they have a temporary need for furniture in markets that we're not present, then we can offer the service here and just be more of a one-stop shop supplier to the large existing clients.
Yeah, no, what I was fishing for was, I think you answered that, whether you would pour millions into mass market marketing to target the normal consumer, but I understand that you're mostly marketing this within your current customer segment.
Yeah, we are gonna explore the synergies that's already present and kind of pick the low-hanging fruits already. Doing a massive launch would also it's for us. It's always been important. We always do this, no matter what we do. We don't want to overreach, so to say. So we don't want to do anything haphazardly. Some might call it conservative or boring even, but we don't want to do anything that will get the product off to a wrong start. We would rather hold it. We would rather do it in a smaller scale. We don't want to create a lot of noise and then for some reason not be able to deliver on the promise, So it will just get the product off on the wrong foot, and we would avoid that at all cost, and we avoid that in everything we do.
Great. I have just one final question, and it's a fairly detailed one on the reported numbers. And we noticed that in your balance sheet, you have a fairly noticeable increase in short-term interest-bearing debt of about 3 million or so. Did you raise any new loans?
No, yeah, good, excellent question. No, we changed banks. We've disclosed this earlier, and instead of having a loan like a bank loan, we have some credit lines instead. So technically, they are replaced by, you know, so technically long-term debt is down and the short-term debt is up, but it's a credit line. It's in my opinion long-term, but if you ask an accountant or an auditor, it's a short-term debt. So that's the reason for that one. More or less, the new bank offers us a better credit line and the lower interest rate. So we were pretty happy with that. So it actually upped our funding capacity by a degree.
Excellent. You know, Patrick, I don't have any more questions for you today, and I haven't received any from the audience. So I think it's time for me to just say thank you very much, Patrick, for a good discussion, and also thank you to the audience for listening.
Thank you for attending, and sorry for the interruption.
Right. Thank you. Bye-bye.
Bye-bye.